I want to end the show today talking about real examples. You know, the market really selling off a week and a half ago, and then refinance rates coming down brought us to a place where a lot of people in our camp have been able to refinance, save money, consolidate debt, even just lower the mortgage payment for the sake of lowering the mortgage payment. Let's dig into a couple examples you have right now on what are people doing and what are ways they can that people watching can take advantage of what's happening in the market right now.
So I know 2 years ago, even last year, the buy down that we spoke about a little bit earlier was very popular, and it helped a lot of buyers ease into their mortgage payment. A lot of my clients right now are calling me back and saying, hey, we're at that mark where it's going to adjust to that higher rate. When we first initially spoke, we said, hey, the goal is going to be that we're going to monitor it for 1 year, 2 years. And in that second year, we're going to look to make that refinance and solidify it at a lower rate so you never go up to that. So a lot of my VA clients right now are calling me back. We're helping out a family, and they actually just had a baby literally on Friday, the day right before I gave them a call to say, hey, it's time to refinance. Wow. So for them, it was very special because, A, they get to put a little bit more money back in their pocket going into the winter, holiday seasons, and then the baby in itself is not a cheap expense once the babies are here. So that's one that, I'm seeing a lot of that. A lot of people are now coming back to refinance their buy down. And the good thing about that is that if you still have a year pending in there, you're going to get that money reduced from your loan amount. So you'll get an additional extra savings. So that's one example that we're seeing. And then the most popular one is still right now the cash out refinance. And what I'm seeing is that, we were able to do a client that had a 5.875 and we literally just took them up to a 6.25, but they were able to take out over $92,000 of their equity to be able to dish out and pay. I want to say they have combined $30,000 in debt, and the rest are just going to keep it for their pocket. Their payment's going to go up maybe like $400.
Oh man. So they're taking roughly like $60,000 almost about that and just kind of holding on to it.
Yep.
Okay.
And
interesting.
then the rest is their payment's gonna go up, like I said, around $400. They actually opt out to not pay property taxes a month and homeowners insurance.
Oh, they don't impound it.
So
they pay twice a year.
Yeah.
Okay.
So they have an even lower payment, and that's one of the things that I'm starting to see a lot. Where people with these rates that came down this last week is that maybe it's time for me to take that equity out and start putting it to use. Now, on the contrary, a lot of people are also looking at the HELOC route. But one of the things that I realized that is if you're using the HELOC to pay off your debt, you're not actually able to, cash that in for a tax write-off. The only reason...
Well, the interest isn't deductible. What you're talking about, the mortgage interest would be deductible, but the HELOC interest is not.
No. So unless...
We have to clarify that because it's a very specific thing, and we're not tax consultants. This is not tax advice.
No, this is not tax advice.
Please seek your local tax and accountant for licensed assistance.
Yeah, but that's actually something that I'm starting to see. So basically right now, a lot of people know that they're in debt.
Can I ask you a question? Yeah. Do you have anyone yet that has called you, or do you have anyone yet that part of the refinance is actually removing their mortgage insurance yet? Is that also happening?
I haven't got someone like that yet. No, a lot of it's more like, VA ERLs, cash out refinances. And then the purchase that I have right now is VA new build.
Oh, I do want to mention really quickly about the VA ERL. So first of all, if you're hearing about that term for the first time, it is an acronym because we love acronyms in the military. VA ERL, Interest Rate Reduction Refinance Loan, IRRRL. And it is a streamlined refinance essentially for the VA product. And there's a rule. There's a safeguard for you. You cannot do the VA ERL unless you save 5% a month or more. So you have to at least save 5% on your monthly payment, or you can't do the VA ERL. It's a safeguard so that people aren't getting unscrupulously lent to and basically kind of taking advantage of marketing-wise. Like, oh, come refinance, and your payment changes by $5. Not enough. It's got to change by 5% or more, better for you. So it has to go down by 5% or more, and I love that feature about the VA because people are like, well, why would I do that? Like, well, you don't have to. But there's also a rule that you're not going to just take advantage of by doing so as well.
No, and like what I said earlier, make sure you're reading your disclosures and seeing what they're charging for the rate that you're getting. Because, you can get the lowest rate, but it's going to cost you a pretty penny.
Yeah, buy down points, discounts.
And speaking about that, I had a client give me a call because 2 months ago they started the refinance process. And they opted to go with a different route. Turns out they gave me a call last week, and they're like, hey, we've been in the process for 2 months. They send me the LE, and the LE is literally the loan amount that they're basically financing. But the numbers just didn't make sense. They were charging them like $17,000 for the rate, and he had a 5.8.
It was discount points, right?
Yes.
Yeah.
He was at a 5% rate, and then they raised his rate to 5.01, but charging him $17,000, and the cash out wasn't even what he wanted to do. So when I looked at it, I'm like, bro, this is like very inaccurately, like property taxes, everything was literally very inaccurately calculated. And that's what I brought up to him. I'm like, hey, like I would just really reach out to them, let them know, ask them these questions, because I never like to knock anybody down and say, hey, they screwed you, they did this. Go back and say, hey, or hey, if they're not answering you anymore, maybe that's the reason why. I would have just done this, and that. And I broke everything down to him. I showed him, hey, this is your loan of value. This is how you can go up. So I don't know how they were able to just show you this loan estimate. And it looks great, but obviously that's not going to fly.
Dang.
Hence, they're not calling you back. He ordered an appraisal. He got everything going and basically got straddled out.
Dude, that's crazy.
Yeah.
Wow,
Yeah,
that's
yeah.
unfortunate.
So-
Well, okay. So what are you doing? What are you doing now, though? So that was the situation he came from.
So we
What is it that-
restructured everything. We got their loan amount right. We gave them the rate that's actually, what it's supposed to be. It wasn't a 5.875. It was a 6.25. And even like last week when rates got a little bit better, we got them down to 6.125. So a little bit better than what it should have been. But
without points, right?
But without points,
so,
exactly.
So the contrast is they were getting like 5 or 5.01% for $17,000.
So $17,000 was just in discounts, and you still have their property taxes, their insurance, and everything else to basically put into the loan as well.
Right, but that was basically the entry fee to buy that rate.
Yes.
$17,000.
And that's the biggest thing right now, that if you're seeing people advertise low rates, just ask them, how much is that going to cost me?
How much it cost me to
How
get
much is
that?
it going to cost me? Because like I said, anybody could give you the lowest rate. Is just probably not going to be the most cheapest.
You know where I see this a lot in like regular commercial advertising is when you see like new car leases. You're like, the new Lexus GS 350, only $499 a month. And you look at the bottom, it's like $7,000 due at signing. Like, wait a minute, hold on, that ain't $499 a month. I gotta pay $7,000 to get it for $499 a month.
So that's
Same idea.
Yeah, it's exactly
Same
the
idea.
same idea, because you'll go based like, oh yeah, 5.875, I could get that, great. And then you go into your document, whoa, why is it costing me this much?
Yeah.
But that's the things that consumers don't really know, and at the time is like, oh well, this is what it should be, or I think this is what it's going to cost me. Okay, I have no choice. People don't really disclose it because sometimes it's like, well, why do I have to pay so much? And they don't want to have that conversation. But I feel that once you're you're really trying to help people, it's not really about you. It's more about how you can solve their problem.
Yeah. Well, something to look out for then. So those of you who are doing a refinance right now, make sure you look at your loan estimate and make sure you check for any discount points. Now, we're not going to say that discount points are bad either. Sometimes discount points are the way to secure the best long-term plan by using some of that equity to convert it into something that's more affordable for you. So it's all situation-based. It's very scenario-based too, because here's the other thing is you still have to qualify for your refinance. So if in fact you have to convert some equity into using a buy down or a discount to get a rate that helps your debt to income ratio meet the threshold, well, then you kind of got to do that too. But if it helps you pay off $90,000 of debt, like that's the give and take. There's something you're going to give up and something you're going to get back, and what you get back is going to cost you something. So just be aware of that.
Yeah.
So and ask good questions too.
Yeah. And rule of thumb is if you're going to be, buying discount points, at least plan to live in the house for more than 4 years, because that's more or less, and don't quote me, don't quote me exactly, but it's case by case.
Yeah, it's very situational.
But it's more or less, a long-term play, because you're going to want that payment to be lower. You're going to be paying for it, and you might not make your money back if you sell the house the next year.
And one of my things I've said off camera, and I think I've said on camera a couple times, but like if you have to do a reset or a redo for yourself, like let this be the one. Let's not try to do it 2 or 3 times.
No. Exactly.
I say this very clearly. Like, yeah, we're in business to do loans, and we make money by doing loans, but I don't want you coming back here in 24 months with the same problem financially.
Oh,
like
100%.
We want you to use this as a fix for maybe a current set of problems. But then if you can move forward in a healthy way, in a healthy patterns, spending wise, so you can avoid this type of bailout, if you will, that's what we really want for you long term.
I think the play right now, and what I'm advising a lot of people that are in, high consumer credit debt, is that make the play where right now you take that equity out, make it work for you, and then take that option once the rates go lower again, and then just bring your payment down again. So it's like you're laying up for that next play, but at least right now you're able to put yourself in order. If things are getting a little bit heavy, like you have that asset. And I know, a lot of people go against like borrowing against their property, but when it's your last option and that's going to free and clear your path to being able to be free, then I think that's something that you should definitely be considering or having that conversation with your spouse and family.
Yeah.